Come here, I want to show you something. We hear a lot of people nowadays saying that they are waiting to buy property. They're going to wait for, let's say, the property starts peaking in price and it's bound to drop. One of the examples they use is that California is so expensive that we're going to have a lot of foreclosures. Something that happened amid in the 2008 meltdown. Now, let me explain to you the whole foreclosure process so you can see why you shouldn't count on foreclosure to buy a property, or count on foreclosure for properties to drop down because then they're going to provide more inventory. So let's start with this. When you don't pay your property, let's say for the first 3 months, or if you're behind 3 months, you're going to get a notice of default. Notice of default. That is 3 months. 3 months after you don't pay your mortgage, your note, you get this. 3 months later, the bank is going to send you another notice saying that, hey, we haven't received your payment, so we're going to send you a notice of sale. That means that the intention is to go to the city or the county and say, hey, this person hasn't paid their note. Therefore, we're going to go ahead and foreclose on this note and take the property so that we can collect on what is owed to us. Now, at this point, what should happen is that you can, 20 days later, after that's filed, your property gets sold and, it's sold in the open market. That is what should happen. However, what is really happening is that homeowners, you as a homeowner, have several options that you can actually use to stop this or to save some time. Because of course we don't want a meltdown to happen similar to what happened in 2008. So one thing that can happen is that you can ask for forbearance. Forbearance, don't mind my spelling. Forbearance means that you stop the payment, the bank allows you to stop the payment so that you have some time, some cushion to save, so that you can save some money or get some sort of financing sorted out so you can pay it off in a lump sum at the end of the forbearance. Forbearance could last anywhere from 3 to 6 months. Let's say it lasts 6 months. So you have 6 months of cushion for you to come up with something. After the forbearance period is done, you can actually go and challenge the foreclosure. Yeah, you can challenge it. So let's go ahead and say challenge. You can have your hearing in court to say, I do not agree with this foreclosure, therefore I want you to stop. Now the court will have a hearing. You can hire a lawyer to help represent you on this, and this whole process can last anywhere from, let's say, 1 to 3 months, or sometimes even longer, depending on how busy or how good your argument is. So let's say this gives you 3 months. It gave you 3 months of argument between you and the bank. After that, let's say that you lose your argument. You lose your argument and your foreclosure is moving forward. Not so fast, because you can actually ask for what's it called? Postponement. Postpone. You can postpone, ask for to postpone on the foreclosure. How? Well, as of today, we're in December. So let's say that you can say, the argument could be, give me at least until January to move out, because it's Christmas, it's New Year's, it's hard for me to find another place. So give me 1 month to move out. You can actually ask for postponement, and that can save you or give you another 1 more month. Don't worry, all this will make sense later. After that, this I don't recommend, but some people go for bankrupt. When you do a bankruptcy, your bankruptcy attorney, I don't recommend this by the way, will say, if you do a bankruptcy, you can actually stop the whole process for anywhere between 6 months to 2 years. Average time, 9 months. So let's say you do bankruptcy, you have 9 months. You can stall this whole process before it starts over again. What happens after 9 months? You already messed up your credit. So what do? You list it for sale. Every time you list your property for sale, you stop the whole process. So a typical agent will list your property for 6 months. Of course, hopefully by then your property will have a buyer to buy your property. They say that you list your property for over market value. So you listen for 3 months, the agent say, hey, you're not serious about selling, we're going to cancel the listing, so you have saved yourself another 3 months. After that, the homeowner have the option to negotiate a loan modification, loan mod. And this is what happens. Properties in California, on average, since in 1971 till now, has gone up 7.5%. Has gone up 7.5%. Since the pandemic in 2020 till now, has gone up 45%. Let's say that on average, the property has have been going up 5%. Let's say from here on out, right? So average property in Southern California is $800,000. At 5%, that's $40,000 each year. Okay, so let's say that you postpone this. On average, foreclosures last between 2 to 3 years. Let's say that you were able to stall 2 years. That's times 2 years. That's $80,000. That doesn't even include the compounding effect because it's 5% on top of the 5% that it went up. Let's say that it's just $40,000 each year. That's $80,000. Not much, too little, but just enough for the loan modification to kick in. Now, what does the bank will do? Likely, well, your property is worth $880,000 compared to $800,000 when this whole thing started. Okay, $880,000. Bank will be more inclined to say, well, you have more equity now. We can take this loan, however much you owe us, these 2 years, and put it on the back of the loan. Now, let's say they owe, let's say 10 years balance. Now you have 12 years balance on your loan. That's one way. Another way that the bank can negotiate with you is to give you an additional interest. Let's say that whatever your interest rate is, they can add 1 or 2 points to make up for that. And add, maybe because you have a loan equity of $80,000, they can take some of that to pay for the balance and add a second note on it. So there are different ways that a foreclosure to stop here in Southern California. Why is that? Because we don't want another meltdown to happen. These are rules that were put in place back in 2008 so that we don't go to that hardship and misery and a bunch of houses in the market abandoned. So if you're looking to, let's say, get a foreclosed property or expecting a bunch of foreclosures to happen from here on out, don't hold your breath because it's not going to happen. See, it is so easy for homeowners nowadays to keep their property, and banks are really not interested in taking that property from you. In fact, they will do everything they can to make sure they can keep it. And we all know these numbers. 5% is very actually conservative. It's 7.5%. So you actually calculate by 7.5, 7 times, yeah, it's 56 times 2. You have a little over $100,000 in equity in 2 years. They say they delay for 3 years. That's what, 150 to 170, give or take. With that said, foreclosures in Southern California, very low, very little. This is Gary Yao, and I'll talk to you soon.